Welcome to the podcast that's dedicated to helping business owners prepare for an exit so that you can maximize the valuation and exit on your terms. This is the Exit Insights podcast presented by Succession Plus. I'm Daryl Bates Brownsword, and today I'm talking to Channing Hamlet. Channing's from Objective Investment Banking and Valuation based in Southern California. Hey, welcome and thanks for joining me today, Channing.
Yeah, thanks for having me. It's always fun to help educate the community about how to sell their companies for a premium. I think a lot of business owners don't fully appreciate all of the elements that come into a successful sale. So happy to be here.
Brilliant. And Channing, as an investment banker, you've got a lot of experience, and we uncovered this in a bit of a planning call, but a lot of experience of business owners coming to you, and when they do a deal, if they're not prepared or fully tweaked their business and in anticipation of an exit, end up leaving a lot of money on the table. You know, when the deal is done, is what you're sharing, and that's something that's near and dear to my heart. Is helping business owners not only just get an exit out of your business, which is a great start because 80% don't get a deal, but we're looking for a successful exit, and entrepreneurs are competitive beasts, so they want to do what's the best they can. So getting a successful exit would mean, ideally with minimal earn-out requirements on them, and achieving a premium valuation if at all possible. And there's a lot that's within their control that they can do to influence the valuation they can get. And there's a few things that are outside of their scope of influence and things that they aren't control. So let's explore, shall we? What are the things that business owners can do to proactively help their business sell so that they are one of the 20%? And then I guess once they've got that baseline covered, what are the things they can do, and some practical examples from you if you've got some case studies to go, here's what a business looks like that can sell, and here's one that'll sell and get a premium price, perhaps.
Yeah, it's interesting. I think it's generally speaking, it's hard to sell a company. It's a very complex and multifaceted process, and it's really hard to sell a company for a premium. And so there has to be something special going on to get a premium valuation. And I think we'll spend some time talking about that. But one of the things I've observed over the years is when a business owner makes the psychological or emotional shift to view the business that they're running or perhaps they founded as an investment of theirs, rather than this is like my lifestyle and I'm all wrapped up in it. And they start thinking about this is probably my largest investment, and I need to start making decisions to grow the value of the investment, rather than I need to make decisions to like maximize my cash flow or make payroll next week. There's kind of a mental shift that goes on, and they're more ready to sell a company. And then there's a lot of personal elements around how much money do I need to support my lifestyle? What's the tax implications of a sale? What am I going to do personally? Family, legacy, et cetera, et cetera, et cetera. And so when someone is not clear on a lot of those things and they're not crystal clear on what they want out of a transaction, it's hard to set up a successful transaction. So I love working with business owners that have taken the time and really put the effort in to have their personal house in order, so to speak, so that we can focus on the business. And then on the business side, there's a whole host of different elements to think through around whether the company is even saleable or not, what it's worth, is it the right time to do a deal, et cetera, et cetera, et cetera. And so there's a lot we could talk about there.
Right. Well, let's get started and dig into it, shall we? So you touched on, I guess, what I'll call the fundamentals. Fundamentals are this is the biggest asset that you've got in most cases, and well, the general market that we're talking to. And you mentioned, and I'll paraphrase, but it's the business that's grown out of the lifestyle business, i.e., an owner and a number of helpers, into someone who's transitioned into a business where they've got employees, and perhaps have even reached the stage where they've made the transition or the shift from thinking about just revenue, year-on-year revenue growth, to thinking that their business is an asset, and they're thinking about asset growth. How do I increase the valuation of my business? And we know that profit or revenue is just half of the equation of a valuation. There's other things. And one of the other ones is, well, other advisors, well, let's get our tax accountant in early, because if we bring them in, they can advise us on how, given our personal circumstances, how much tax we're going to pay, how we can minimize the tax we have to pay, and then manage our expectations around what's left, what's going to end up in our bank account, and if that's enough. So that leads us to, well, we probably want to get our personal financial planning in order, speak to our financial planner and go, well, how much do I need to, from the exit of this to get the lifestyle, or to fund what's next in the way that I want. So there's some 2 or 3 preparation steps that we need to get done first before we even start, talking to you per se. And with the personal financial planning. And if we know what that is, and the personal financial planner and the tax advisor have said, hey, look, to get what you want, life after business, whatever that looks like for you, you're going to need this much in your bank account. And there's the foundation, if you like, of a valuation from the seller's perspective. What they need to know then is a buyer going to see that value in the business, and is a buyer's valuation going to be bigger than that number or smaller than that number? And then they'll give us some planning ideas of what we need to do from there. Does that sound fair?
Perfect. Yeah.
Yeah. So if let's assume that someone's gone and said, hey, look, I know where I'm at, I know what the business is worth, and now I need to get some of those internal and external factors, because what are the things that they can do to start to put in place to make sure that they, assuming they've got some time, to get their business to a point where it will attract, or be sellable, I think in your languages, at a strategic valuation. How do we get that strategic, that higher than average valuation up in your experience?
Yeah, I mean, I think there's a number of things to look at in terms of getting a premium valuation. And when companies come to us, the 2 things that we kind of look most closely at, I'd say there's like 4 things to really look at and understand, but the 2 things that we look most closely at are, what are the risks here, and is this business even saleable? So if a company has some sort of systemic risk, one large customer, one large vendor, reliance on a key individual, some sort of pending legal or intellectual property issue, or something like that, where it would be hard for a buyer to get comfortable that there's continuity in the asset. It often becomes very difficult to sell the business, and very, very difficult to sell it for like a cash up front type deal. Those are some things. Those are some things we've looked at, and I've personally been involved in otherwise great companies where customer concentration killed a deal, vendor concentration killed a deal. Sometimes in these vendor contracts, the vendor has the right to approve the buyer or a change of control, and it's like, the company doesn't want to go talk to the vendor until they know the buyer is interested. The buyer doesn't want to put time in until they know they're going to get the relationship with the vendor. And so there's we've had companies where there was some question about the origin of the intellectual property and who owned it. And, as an individual running a business, the intellectual property stuff is all well and good. Now you go sit down with a public company that wants to buy your company, and the board of directors is hearing from their attorney, oh yeah, this company might not own their intellectual property, which they generate 75% of their revenue from, but you should buy it anyway. Don't worry about that. Like board members don't take those types of risk. And so I think a lot of business owners underestimate how pristine a company needs to be as far as really having their T's crossed and their I's dotted in order to sell for a premium. So like the salability factors are one thing we look at. And then the next thing we look at is what I would call value drivers. And every industry and business has different value drivers. And, you don't need to like some sort of advanced degree or anything to know that, revenue growth and strong margins, EBITDA are value drivers. But there's a whole host of second level things that we look at. Having a management team in place so that there's continuity to the new buyer is a big value driver. Um, and if a business is highly dependent on the owner and they don't have a good succession plan in place, the buyer is going to bake in additional cost and risk of that transition. That, like I'm gonna write, as a buyer, I'm gonna write a fat check to the seller. He or she is going to be way less motivated to show up Monday morning after the deal closes, and then I got no one to run the business for me. I need to bake in additional cost and additional risk into my valuation, so that's going to drop the valuation. And so, going back to what we talked about at the beginning of the call, if you view your business as like, hey, I want to make money this quarter, you probably don't spend time, effort, and energy hiring a CFO and this executive and that executive, because it's going to cost you in the short term. If you view your business as an asset where you're trying to build the value, you can get a very strong return on hiring a good CFO and a good marketing person and a good salesperson, et cetera, because the transferability and continuity that you can offer a buyer is like massive ROI in terms of the valuation. And so it's a psychological shift that a lot of business owners don't appreciate. A second big value driver that we see is intellectual property. A lot of businesses have, even service companies, but a lot of businesses have intellectual property, but they haven't really thought about how to organize, how to position it, how to protect it, and how to make themselves unique. And so that's a second, really big value driver. The more a company can outline a lot of their processes and systems and, prove to a buyer that it's proprietary and unique, that's the, cash flow that's generated from an asset that's proprietary and unique is worth more than cash flow that is from an asset that anybody could build. And so that's another like real value driver. A third one we look at is, in different industries have different metrics. A lot, like when I first started in investment banking, I did some work in the security alarm industry. And at that point in time, businesses were valued based on how many customers they had and what their retention rate was. The buyers didn't even bother looking at the profitability, because they were going to take all of the customers and put it on their system.
Yep.
And so you could look at two security alarm companies, one that was like rapidly growing with good retention rates but losing money, and then another security alarm company that was stable and profitable. And the one that was rapidly growing and losing money was worth more because the buyers were valuing it on the customers. And so, maybe it's irresponsible. Your listeners are sitting here like, oh, hey, it's irresponsible to like lose money in the interest of growth. But I would submit that at least being aware of that dynamic in your industry, so that you understand it, could be really important in driving value. And then I think a couple others that we look at is, what is the predictability of the business? Have you built in recurring revenue or repeatable systems, or if I do more of this, I get a customer, and then if I do this, I keep that customer, and if I do this, I generate stronger margins. Have you built these systems in place so that the business is predictable and repeatable? A lot of companies that come to us, and these could be companies that are worth 40 or $50 million. They don't do budgets on a regular basis. And so when we sell a company, like if you were going to hire me to sell your, it's end of 2023. If you were going to hire me to sell your company right now, I would be trying to sell it on a multiple of 2024 financials. So in order for me to do that, I need to have like high confidence that the budget and the financial plan for 2024 is accurate, supportable, defendable, and achievable. And if you have not been doing budgets on a regular basis, now you're putting me in a position where I'm the first person ever to create a budget for your company that I'm going to try to convince a buyer is real to get a value off of next year. That's really difficult. And so if you've been doing budgets for a long time and you know all the drivers of your business and you've got it systematized, it's way easier to convince a buyer that the growth is there, the improvement in margin is there, this is there, that's there. And then you can get a premium. And, a lot of what I'm talking about is not hard to do, but it does take time, effort, work, and focus. And it's hard to do it in the narrow window of time when you're in the middle of the investment banker
Yeah.
process.
And you want all those things in place to be habits, not just one-off actions and activities
Yeah.
that are, for this
Yeah.
exit process, because they just won't stick. And then it'll be exposed during due diligence.
And one other thing that I think is maybe not necessarily a value driver, but it definitely helps facilitate a transaction, is to have really good reporting and analytics on the business. A lot of owners, a lot of the clients we work with started their company, and they just know their business so well. They know, like, hey, if I charge $10 for this, or $150 an hour, or $8 per mile, or whatever the metric is, I know I'm going to make money. But what you really want to be able to do is, like, be able to sit down with a buyer and explain how you make money. And so a good CFO or a good business analyst that really starts to track the metrics, revenue by product line or revenue by service, margin by product, margin by service, et cetera, et cetera, et cetera, so that you can explain how the business works, where you make money, what's going on, what activities you're getting an ROI on, what activities you aren't, so that you can make it easy for a buyer to understand the business. That's worth quite a bit.
Yeah.
That's worth quite a bit as well. And so we have a lot of clients come to us, and they haven't really invested in the reporting systems and analytics to understand their business. And I think a lot of buyers look at that as a risk.
Yeah, for sure.
And a lot of buyers look at that as a risk, and a lot of private equity firms that buy companies love that dynamic because they can pay less for the business and then make those investments when they own it, which is kind of low hanging fruit to improve the value, improve the understanding and value of the business going forward.
Yeah. So now, I think you said there were four things that you need to get a premium. I've got risks. Is it saleable? Value drivers, and what was the fourth one?
Yeah. So really, I think we look at the saleability factors, which is risks. What are the value drivers? And then the third one is, like, what's going on in the market. And just a quick story on that. I worked with a commercial printing business when I first started in investment banking. And at that point in time, printing was still a thing. Like, the internet, digital marketing, and all that stuff was in its infancy. And so
Right.
companies were still printing glossy brochures, et cetera. Private equity and the public markets had built a number of companies that were on massive acquisition sprees. And so when we sold this company, we literally had an auction with 7 buyers, and we got them to bid like multiple rounds against each other and just kept ratcheting the price up and up and up. And we sold that company for, a very high multiple for a printing business. 20 years later, internet, digital marketing, email, et cetera, like, the printing sector had, like, somewhat been commoditized by a lot of this technological shift, one. And two, a lot of the companies that had made acquisitions had gotten so big that they were not necessarily focused on buying small companies anymore. And so the company that we sold 20 years later, arguably a better company with better technology and better management, it was a battle and a struggle just to find buyers that are interested. And so now when you have buyers that are barely interested, it's really difficult to get a premium valuation. So that company sold for it was a better company that sold for a lesser multiple. And so I think this, like, market timing and understanding of what's going on in the industry and how to capitalize on that is pretty important. And so this goes back to what we talked about at the beginning of the call, or the beginning of the conversation. um, when a business owner has made the mental shift that, like, hey, this company that I run, that I started, is an investment, and so I'm going to start paying attention to the market. And market values are high right now, they're low right now. I got tailwinds, I got headwinds, et cetera. Just understanding where you are in that cycle, and what factors are likely to be changing to change that cycle, can be part of the discussion. And I'd say one of the hardest things that we advise business owners on is, should I sell this year or should I hold on? And, part of that is like what do you believe is going to happen in the future? And part of it is like, really looking at trends and having a good finger on the pulse of the market. And so that's a third area, is just sort of what's going on with the market and economic environment. And then the fourth one is, what process do you use to sell the company? I think we've had a lot of expertise, and our whole profession exists by running a formal, diligent auction process to get multiple buyers interested in bidding against each other, which you can drive the price up. You can drive the price up very significantly. And so really and it's not, the investment banker process isn't right for every situation, but when it's right, it can make like a really big difference. And understanding that and being prepared for that can be a fourth value driver.
Yeah. And one of the takeaways I heard, and I guess perhaps reading between the lines, is if I've done a lot of those things, like I keep good records. I've got all my human resource, my employment records, my contracts, my agreements, my supplier agreements, all of my processes. My business is systemized and operating smoothly and predictably. I think was the word you used. Then and I've got a management team in place, so the business isn't dependent on me as a key person. So there's some of the key areas, and perhaps I've got some IP as well, which is proprietary to my business, or even if that's a process. And I want to dig into that in a second. But if I've addressed those key factors, then I'm in a position to be opportunistic. So I may not want to sell my business for 5 years' time, but if I see that there's things happening in the industry, in the marketplace around my industry, and for whatever reason, businesses in my industry are selling at a premium at the moment, I can take advantage of that because I'm ready. I'm already on the front foot. And then I can go explore and go, well, maybe I do sell my business now. It's 3, 4, 5 years earlier than I wanted, but yeah, things are peaking, and it's always hard to time the market. But if things are going off in my market at the moment, my industry, then I can take advantage. If I the alternative to that is, if I see things, oh look, my business is firing off at the market at the moment, then I have to get exit ready, which might take 2 years or 3 years, by which time the opportunity's passed potentially. And then before you know it, I'm blockbuster.
The two thoughts for you. One is, when a business is exit ready, the owners typically enjoy owning it and running it more, because it's easier and less stressful. And then the second thing, it's over the last kind of 18 months, we've had a lot of economic and other volatility in the world. And so it's hard to have confidence right now that, hey, this is a great time to spend the next 9 months running an auction and selling my company. But what's happening right now is there's still a lot of capital out there. Private equity firms have more dry powder than they've ever had. And because of the economic environment, deal flow is down. So there's a supply and demand imbalance on deals. Public companies are starting to face economic slowdown, and they have a lot of cash and capital. And so there's this situation where a lot of companies are being approached by one or a handful of buyers. And so a lot of our clients have come to us with 1 or 2 buyers interested, and they're kind of like, hey, help me get a deal done. And when they're organized and ready, I mean, you can mobilize and you can close a deal in 3 months, 4 months at a premium. We have a company that we've been talking to for the last 2 years. It's an industrial components business. And the CEO was kind of thinking about retiring at some point in the next kind of 5 to 10 years. And he had started to cultivate relationships with a handful of buyers, and he got an inbound offer that was a premium valuation. And, we mobilized a team, and that deal will close kind of 90 days from the time our firm had the first discussion with the buyer. They were organized, they were ready, they were doing everything right. And they were able to take advantage of a unique opportunity to sell their company for a premium. So I think there's really something to be said for that. On the flip side, another story comes to mind. 7 or 8 years ago, I was introduced to a company, and there were 3 founders. There was a sales guy, a technology guy, and an operations person that got together and started a company. And they had built it up, and they were each making an income of north of $1 million a year running this company. So they built a nice business that had 3 million plus of cash flow annually. They got they got an offer from a buyer, which was like, hey, we'll give you a little bit of cash, and there's an earnout, and we'll give you some stock in our company. And I sat down with the one of the three partners and was like, do you have audited financials? No. Do you do this? No. Do you do that? No. Do you have a succession plan? No. Do you have, and the answer was like no to everything. And in the deal they had on the table wasn't great. And so we came to the conclusion with them. It's like, hey, why don't we help you build a roadmap of all the stuff to put together to sell the company? And um, uh, over a series of meetings, and they worked with some other consultants and CPA and attorney, and 4 years later they showed up. One of the three founders was having some health issues, which prompted the sale of the business. And so they showed up, audited financials, good analytics. Each of the three positions had their succession plan in place, so they had a management team ready to take over.
Yeah.
They had diversified away from one of their large customers, by cutting back revenue at that customer and getting other customers.
Right.
There was a very strategic and calculated process they went through to diversify their revenue base. They shifted their contracting from annual contracts to 5-year long-term agreements. And they did all of these things to both prepare for sale and make the company valuable. And when they came to us to sell the company, we were able to run like a very aggressive auction process. And we had 30 offers. Wow. And we ultimately narrowed it down to, through this auction process, we ultimately narrowed it down to 2 buyers. And our client was able to pick the buyer that, and they were both very good deals. They were able to pick the buyer where they felt like they wanted to work and continue to grow and build the business. The one guy that was having health problems retired right away, and the other 2 people worked for that new buyer. And I, still work there years later. And so it's a real success story and kind of a testament to, the time and effort and preparation they did. And the business sold for 5 times what the offer they had, 4 years earlier, was. So this proactive strategic planning process that they put in place to address a lot of the issues, turned out to be really amazing for them.
So you just slipped that in, but let me just check. Did I hear that correctly? The difference between a business, the valuation for a business that's exit ready and not
5
exit
times.
ready was 5 times. 5 times the valuation by being exit ready. So if you're on the front foot, exit ready, you can take advantage of an opportunity. You'll be ready. And the other thing you slipped in is best case scenario is that a deal can be done in 3 months.
Yeah.
That's significant. Like there's what's the average? So many other businesses are on the market for a year. You're just trying to get a deal.
I think, in speaking to my peers in investment banking, I think that, if you Gantt chart or build a timeline, a sale process takes, call it, 9 months, 3 months, 2 to 3 months to pull all the materials together and buyer's list, financial modeling, write a SIM, confidential information memorandum, 2 to 3 months to market the business and get offers from buyers, and then 90 days to do due diligence and close a transaction. Often the due diligence and closing process can take longer if the company's not organized. And so I think it's a 9 to 12 month process to sell a company. Certainly when we've had companies where there's a lot of buyer interest and they're really organized, you can reliably close a transaction in 3 to 6 months. You can reliably close a transaction in 3 to 6 months. So, really there's something to be said for, being ready. So once you're ready, you can move quickly, because the transaction process is, difficult and stressful.
Yeah. So that's 6 to 9 months of less stress and wonder, and am I going to close this deal? Are they going to keep chipping
Mm-hmm.
away? Are they going to complete? Yeah, but if you're exit ready, it the buyers can, they're less concerned because it's less risk, so they don't dig as deep because you're getting the information to them quickly. They're satisfied, and you address their concerns really quickly. So the
Yeah,
key takeaway here.
when you can send audited financial statements to a buyer, and you can send them all of your material contracts,
Yeah,
and there's not a series of discussions around like, oh yeah, we never got a signature on this one, but we've been working with them forever, and we don't do audits, but our financials are close enough to write, don't worry about it. Like, when you're having those discussions, like, buyers are going to dig deeper because they don't know what they don't know, and they dig
yeah,
deeper. When it's like, I got audited financials, here's all my contracts, here's my employment records, here's this, here's that. um the buyer stops digging and analyzes what you have, because you've given them great comfort that they have what they need to have in order to understand the business and understand the value and the risks. Things
yep,
move much quicker.
brilliant. So Channing, let's pull it all together, shall we? So you go that there's four things that you really need to think of or work with if you really want to sell your business at a premium price. And the first one is you have to have addressed all of your risks. And these are the risks that are a risk to you as a business owner on a day-to-day basis, but they present a risk to a buyer buying your business because what they're just looking for continuity and
And
predictability.
one thing on the risks, and you just said the right word, is continuity. And so, what you, as a seller, what you want to be able to do, provide the buyer, is um, high confidence that there will be continuity. No one wants to buy a business and then have the top customer leave the week after they bought it and they overpaid by 50%. And so, one way to solve those problems is to structurally solve them in the business. But another way to solve them, like, we sold a company that their top customer was 35% of their revenue. Our client went to the top customer and basically said, hey, we're thinking about selling our company. Can we use you as a reference? And B, can we extend our contract a couple years so that we can provide continuity to the buyer? So when we would call buyers, they would say, is there one customer that represents a significant portion of your revenue? We'd say, yes, there is. We already went to that customer. We have a long-term contract with them. Here's the name and phone number of the CEO of that customer. You can call him anytime you want and ask about the relationship. Like,
Yeah,
we proved there was continuity. We didn't solve the problem. It was still 35% of our revenue, but we proved to the buyers that there were continuity. Where most of our clients that have a large customer are like, well, we have a great relationship with the customer. Okay, great. Can you call them and tell them you're thinking about selling? No, we don't want to screw something up with the relationship.
yeah,
Wait, which is it? Do you have a good relationship, or are you nervous about having open communication with them? And so, I think, like, really sort of thinking about not necessarily solving the risk, but how do I provide continuity around the risk is another way to skin that cat, and
yeah.
often it could be easier.
Well, you've preempted everything and addressed it up front.
Exactly,
So,
exactly.
so the risks are the first thing. The second one is know your value drivers. What are the things that bring value? And one of the ones that, the key ones is have a proprietary product. What are the things that bring? And another one I imagine is have a strong brand, which is really hard in a small business. But have people attracted to your business brand and not have them coming to the person or the individuals in the
Mhm.
business. Um, then you
And
move
on the
on.
value drivers, another tip that we often give business owners is there. I mean, our firm does this, but there's a lot of firms that do valuation work
Yep.
and will help understand and identify value drivers. And, like, we have a process where we can work with a business and give them a prioritized set of things they should work on to improve value. Um, Another two things that I always encourage business owners to do, you know, meet with investment bankers somewhat regularly. Like investment banks will do free work for you, telling you, because they want to create a relationship, so they're there when you're ready to sell.
Yep.
They'll do free work. They'll tell you what's going on in the market, what buyers are paying, what they're looking for, et cetera, et cetera, et cetera. And you can, if you listen carefully, to what they're saying, that gives you the roadmap around, building value. That the example I gave you of the three guys, that's
Yep.
exactly what they did. We explained to them what they needed to do to create a premium, and they did it over the next 4 years, and 5 times more money. So I
And
think
that
just having the mentality to do some research around the value drivers, and talk to buyers, talk to investment bankers, pay attention to what's going on in the market, and see what you learn and bring that back to your company, that can be really valuable.
Yeah. And that leads us nicely, and you've sort of covered it already, that the third one is understand your market dynamics. Know what's going on in your industry and the trends in your industry, and especially the trends in your industry about businesses being bought and sold. And if you know what's going on there, then you can
Mm-hmm.
be on the front foot and anticipate a move and be ready.
Mm-hmm.
And the fourth one is, well, you've got all those things in place now. Now is if you've got those things in order and you've got your house in order from that perspective, then there's the process of actually selling your business. What process? Are you just going to put it on the internet and
Yeah.
in Craigslist or eBay, or are you going to have an investment banker as investment banker process suitable for you and your business, and your size of business is going to make a difference as well. And
And
yeah,
there's a whole conversation around, all the different flavors of the sale process. Do you run an auction? Do you run a targeted process? Do you work with one buyer? Do you do this? Do you do that? There's a whole discussion around the pros and cons, and what's right for which circumstances. But um, I just like, if business owner has put some thought into it and really understands it, they're ahead of the game in my experience.
totally. And look, they're the external factors you can't control, but you can definitely take advantage of them and recognize them as opportunities or threats, and you can act accordingly. So Channing, look, thanks. You've shared it, and just to recap, address the risks, know your value drivers, keep abreast of the market dynamics in your industry, and then pick the right process for your business, and surround yourself with several advisors, exit planners, personal financial planners, tax advisors, and the right investment bankers and people to help you sell the business. But Channing, so pulling that together, is there one singular key message that you want listeners to take away after listening to
I,
this podcast?
I think the saying, "Failing to plan is planning to fail," comes to mind. I
Yeah,
think just the people that we've worked with where we've had successful transactions have put a lot of time, effort, and thought into building a business that's saleable and valuable. It's not easy, and it doesn't happen by accident. And so, a lot of people say, look, I'm just going to build a great business and then someone will come along and buy it. And, I think there's some truth to that. Building a great business is, sort of a core foundation of having a business that can be sold. But I encourage people to not do that at the expense of the rest of the research, to really show up and be prepared and kind of understand the process and understand what's going on. And so I think planning is really important. And then I think every single client we've ever had underestimates the level of scrutiny that buyers show up during the process, and as far as due diligence and crossing every T and dotting every I. And as soon as they find one thing that isn't kind of pristine or there's risks, they take advantage of that. And so the planning and preparation just mitigates a lot of those risks before you even start the conversation.
brilliant. And the key takeaway for me, Channing, I'm going to say this again because I think it's super powerful. It says if you get your planning right and you do your planning up front, the likelihood is that you can increase your valuation by 5 times and halve the time it takes to go through the sale process. So that's all upside as far as I'm, less stress, massive valuation. You get to exit on your terms. You're exiting like a boss. Channing, Hamlet, thanks for sharing your exit insights with us today.
Yeah, thanks so much for having me. I really appreciated it.
I hope you enjoyed this episode of the Exit Insights podcast. And if you have, now's a good time to subscribe and make sure you get notified of all future episodes. Now, if the topics have raised questions about the value potential in your business or how you will exit like a boss, then contact me and arrange a free strategy call where we can discuss what's required for you. Otherwise, if you'd simply like to learn more about how to prepare for when you want to exit, then you can download a copy of our ebook called It All Begins with Insights. The link is in the show notes. In this book, we'll show you how a business insights report can be used to assess your business to uncover your intangible assets and identify the value potential if you're ready for exit and your business is exit ready.